Is it better to buy a house now at today's interest rates, or is it better to wait and see if the market drops and risk paying a higher interest rate? I'm noticing a lot of buyers are frozen or hesitant right now because there's a lot of uncertainty about what's going to happen in the market and if maybe prices might drop. And you know what? That's totally fair. Prices are dropping in other markets, but they haven't in Edmonton yet. But that doesn't mean that they won't if the market continues to shift. So I'm not surprised that people are afraid of this possibility. Nobody wants to buy a house and then start losing money or losing value on the house shortly after purchasing it. That would totally suck, right? Well, not so fast. If the value of houses were dropping, but interest rates stayed the same, then that would obviously suck, because then it would be totally clear that it would have made sense to wait, since there's no incentive to actually buy now instead. If interest rates stay the same later and prices have gone down, then you're obviously going to save money by waiting. But if interest rates are going up at the same time that values are dropping, it's not quite as clear which way is actually the better way to go, because your cost of borrowing is also going to go up. That makes the choice of whether to buy now or wait to see if the market drops a little bit more complicated. So in an effort to help you decide, I wanted to make this video and explore a few different scenarios for you, mostly looking at the financial side of it, to help you figure out whether it's better or not for you to buy now or wait. But before I do that, I also want to go into some of the other factors that could influence your particular situation. This is not going to include everything, but I kind of brainstormed a list of different things to do with your life circumstances that could also affect this decision for you. So let's jump into those now. Here are some of the factors that will affect which choice is best for you. The purchase price of the home, so what you would actually be buying a house for. And the reason that this could be a factor is the larger the purchase price or the larger the mortgage that you're looking at getting, the bigger the impact it could have on you if interest rates go up. A $400,000 mortgage versus an $800,000 mortgage will start to make a pretty big difference on what your actual mortgage payment would be. So if you are looking at a higher priced property, you might be a little bit more sensitive to those higher interest rates and be more tempted to buy something now at the values that you see right now and at the interest rates that you see right now. On the other hand, if you're looking at a lower purchase price, then maybe it won't make quite as big of a difference just from the actual mortgage amount, but that is a factor either way that could affect your decision. Another factor is how much money that you have for a down payment, and also if waiting will allow you to save up more money for a down payment and potentially reduce the amount of the mortgage that you have to get. If you just barely have enough to buy a house right now and you could be a little bit more comfortable if you waited a little bit longer, that's also a factor you might want to consider. Another factor which we're going to be exploring later on in this video is whether the market drops, stays about the same, or goes up. Obviously, nobody knows for sure what's going to happen, but depending on how that plays out, it is going to have a big impact on which choice would have ultimately been best for you, even though it's just speculative right now and you're sort of guessing. But whether or not they go up, down, or stay the same is going to have a big impact on which one would have been the best choice for you, at least. Another factor is actually when you're ready, willing, and able to buy a house. Are you even ready to buy a house right now? If you're not ready and you still need more time to save up or fix your credit or work some other things out, then it's not going to be as relevant because you don't even have the opportunity to buy right now. So if you're in the boat where you need another 6 months to a year, then you're just going to have to roll with whatever the situation is at that time, whether it's better for you or not. The reality is, if you're not quite ready yet, you have to wait until you are ready and you do have your ducks in a row. Okay, and one of the other factors is how much interest rates increase, how quickly they go up, but also how long they stay elevated. I am going to be making some assumptions in the scenarios I'll cover in this video about interest rates. I am still just sort of guessing based on different information that I've read and what some economists are projecting as well. But obviously, if interest rates only go up a little bit, that changes the game a little bit. Or if they go up a lot, then that also is going to change how the scenarios play out and what would end up being best for you, but also how long they stay elevated. If they only go up for a year or two and then start coming back down, then that also could change which option is best for you depending on your timeline and when you were looking at making a move. And sticking with the interest rate sort of theme, another thing that will affect whether it makes sense for you to buy now or wait is if you're planning on going with a variable interest rate or a fixed interest rate. The scenarios I'll cover in this video are looking at fixed interest rates on 5-year terms, But if you're looking at a variable rate, it's not going to make as much of a difference since you'll just be coming in at whatever the market rate is at the time. So you don't really risk locking in at a rate and then potentially in a couple years, if the rates have come down, missing out on that and still paying that higher rate. That is also something else that could happen. If you're going with the variable rate, I don't think it's going to make as much of a difference for you. And here's another thing to consider is, what will your cost of housing be while you wait to see what happens in the market? Are you renting right now? Are you staying with family? Are you going to have a large cost of housing while you wait to see what happens with the market, trying to time the market and find a better time or the perfect time to get into the market? I do think it's important to consider, if you have high housing costs right now, there might be an additional cost associated with that versus buying. Or if your housing costs right now are going to be lower than what you anticipate your monthly cost to be on buying, then I don't think there's quite as much of an incentive for you to get into the market now. But that depends on your situation and what your cost of housing is right now. Okay, here's another one. If there's any changes in the availability of financing or any government regulations that change your ability to get financing or make it easier or more difficult, that is another factor that you don't really have any control of. And it is something that could change. It has changed in the past when the government introduced more stress tests, which essentially reduced people's buying power for purchasing a home. So if there was more changes like that, that is another factor that could impact your ability to buy a home in the future, or how much you can purchase in the future. So that is something to keep in mind too. There are factors outside of your control. Okay, we got two more factors to cover here before we get into the comparisons. And the one I want to focus on right now is your housing needs. So what are your housing needs in the meantime while you're deciding to, potentially wait and see what happens in the market? Do you already have to make a move right now, or is your current housing situation going to work for you while you wait 6 months, a year or two to see how the market plays out? If you need to make a move anyway, because maybe you've got a growing family and you're going to have to go rent another place anyway, there's also a cost associated with that, and inconvenience and the cost of moving, signing a new lease, all that kind of stuff. Whereas if you're already in a place where you're comfortable and you're not going to have to make another move and it can work for your family right now, then maybe you won't have as much of an incentive to get out there and buy right now. Whereas if you're in a living situation right now where it's already either maybe not enough space for you, or for whatever reason it doesn't quite work for you and your family, you're going to have more motivation to go and make a move regardless. And if that's the case, if it's choosing between buying now and potentially risking market values going down versus going and renting, you have to end up going through two moves then. So I do think that's a factor that's important. If you're in a situation where you're going to have to move anyway, maybe that'll influence you more towards just buying now instead of going and renting and then waiting to see what happens to the market. And so the last factor I wanted to look at was you and potentially your partner's job and income situation. Do you see any possibility that you or your partner could have a change of job, lose your job, get laid off, potentially take time off because you're having children, different things like that? That can affect your ability to qualify for financing. So the example I would give is, let's say you're planning on having a child. If you and your spouse are both working right now, if you purchased a home together, you'd be able to use both of your incomes to purchase a property, and that could increase the amount that you could borrow and get a bigger house, let's say. But as soon as one of you takes time off because of having a baby, you might lose one of your incomes and not be able to purchase as much. So for some people, that could be a factor as well. Depending on your situation, you might want to be able to use both of your incomes to buy what you want, whereas other people, they might only want to make sure that they don't, stretch themselves too much by using both incomes if they know they might lose one of them, at least temporarily. So that's something to consider as well. But changes in your jobs, whether it's related to something like that, or if you might want to change jobs. When you change jobs, often when you do that, you're going to have to at least get past your probationary period. So sometimes that can delay you as well in being able to use your income. So if you and potentially if you've got a partner, if you both got good steady jobs right now and it's good for qualifying, there is definitely an incentive to potentially do something now while you've got that lined up, instead of waiting and then potentially something changing in there, and then it basically changing what you can qualify for. Okay, so are you starting to see how this is a little bit complicated, and trying to pick whether you should buy a house now or wait and see what happens in the market and see if prices drop is a little complex, and it's not exactly straightforward? Well, yeah, I thought you'd probably come to that conclusion if you haven't already. There is something to be said about taking the opportunity to buy a house right now if the conditions are just right for you and your family, because you never know if something could change in your situation that could make it so potentially you're not able to buy next year, or you're not able to buy the same amount next year. Like there are things outside of our control. So I do think it is worth considering if you're ready, willing, and able right now and you are able to do something. There is an argument for potentially why you should just do it if it makes sense for you and your family right now. I'm not saying that that means that just because you can buy a house right now that you should. I just wanted to point out that just because you can buy a house right now doesn't mean that you will be able to next year in case things change. And it's basically because of some of the factors that I just described, and there are other scenarios and different factors that could affect it as well, but I just wanted to kind of throw a few different things at you to consider so that you're more aware of how fluid the situation can be depending on what's going on in your life and the market and financing and what's available for you out there. Okay, so let's get to an actual comparison, running a few scenarios. Obviously, I can't focus on all the different factors that I just went through, but there are a few things that I can focus on. And obviously, I'm going to focus on the financing side of it. So I'm going to be looking at things at different purchase prices and at different interest rates. Those are the main things that I'm going to look at. And that's essentially looking at when the purchase price changes, that's representing the market dropping or staying the same, and then interest rates going up is making the assumption that interest rates are going to go up. So we can at least compare those two things and see how different purchase prices and different interest rates affect what your mortgage payment is, as well as how much you'll owe on your mortgage at the end of a 5-year term. So that's some of the factors that we're going to focus in on the most for our comparisons. For our first example, we're going to assume that you're looking at buying a $500,000 house with a 5% down payment at 4.14% interest on a 5-year fixed term. And the reason I'm using 4.14% interest on a 5-year fixed term is because right now that appears to basically be the best interest rate that you can get on a 5-year fixed term if you're going through a mortgage broker. Some mortgage lenders are already around that 4.24% mark. So I think I'm being pretty generous using 4.14%. Obviously, if you got pre-approved previously, a few weeks ago, a month ago, 2 months ago, you could have a rate hold in place that could be significantly better than 4.14%. And if that's the case, I do want to remind you that there might even be a bigger incentive for you to buy now instead of waiting to see what happens with the market, because you'll have bigger savings on the interest rate. I'm not running numbers on that right here. If you reach out to me, I can do that for you specifically, but I wanted to do the comparison in this video for someone that's new, just coming into the market. They're just getting a pre-approved right now, and maybe they'll get a rate hold at that 4.14% mark. So that's why I'm using that as sort of the baseline in these scenarios. But if you're wondering, you can reach out to me at 780-819-5508. You can either text me or call me, and I can actually run through scenarios like this for you and your situation. Okay, so let's look at this. So basically, the question we're trying to answer with this scenario is it better to buy a $500,000 home today with 4.14% interest, or a $450,000 home tomorrow or in the future at a higher interest rate? And the interest rate that I'm going to use for buying it in the future is 5.5%. So I'm assuming that the market's dropping by 10%. So if you were looking at a $500,000 house today, if it dropped by 10%, then that house would be worth $450,000 in the future. And I'm also assuming that interest rates will go up from that 4.14% to 5.5%. Obviously, they could go up more than that. They could go up less than that. This is just sort of a guesstimate so that I can run a scenario and at least compare something. It's not going to be the reality of what happens, but it is just a scenario for us to look at. Okay, so here I'm just using the CMHC mortgage calculator, and I've got the two scenarios side by side. So one of them, it's a $500,000 purchase price. 5% down is a $25,000 down payment with a 25-year amortization at 4.14% interest on a monthly basis versus $450,000 purchase price. 5% down payment is $22,500. 25-year amortization at 5.5% interest. And what you can see is your mortgage payment would be $2,636 on a monthly basis if you bought now, essentially, and you'd have a mortgage of $494,000. And the reason that you've got a mortgage of $494,000, even though your down payment's $25,000, is because you do have to pay mortgage insurance on top of that. So there's a $19,000 mortgage insurance premium being added to your mortgage amount. And it's going to do that in both scenarios since we're just doing 5% down. But I just thought I'd point that out. So that's what your mortgage payment would be. And with the other scenario, buying at $450,000 at 5.5% interest, your monthly payment would be $2,713.80, which is actually a little bit higher. Even though you're buying a house for $450,000 instead of $500,000, because of the interest rates jumping from 4.14% to 5.5%, your mortgage payment would actually be a little bit higher. So that's actually $77.63 higher because of that higher interest rate. You won't be saving any money on your actual monthly payment if this happened to be the scenario that happened. But that's not quite the whole story. If we look here at the mortgage balance, we can look at what your mortgage balance is after 5 years. And in the first scenario, you'd have a mortgage balance of $433,140 at the end of your 5-year term. And the second scenario would have a mortgage balance of $398,918 at the end of your 5-year term. That's a difference of $34,222. So even though your mortgage payment's a little bit less each month, you do still have a bigger mortgage balance at the end of your 5-year term. So you would have paid an additional $4,657 in mortgage payments over the course of the 5 years with the second scenario, where you're buying at $450,000 higher interest rate. So that would eat into that balance a little bit, but you're still seeing, a little bit less than a $30,000 difference in how much you've actually paid and owe after that 5-year term. So in that case, I think if the market did drop 5% and interest rates only went up to 5.5%, technically, I think you'd probably be better off waiting if that's what you think will happen. If that's the scenario that played out, even though that your mortgage payment would be a little bit higher on a monthly basis, you would be in a better position in terms of how much money you actually owed at the end of your 5-year term. Let's see what happens if we do the same scenario again, except instead of the market dropping 10%, it only drops 5%. Again, we've got a $500,000 purchase price, $25,000 down payment, 4.14% interest. We still have that $2,636.17 mortgage payment and a mortgage of $494,000. Whereas if the market dropped 5%, then that would mean that you'd now be able to purchase that same $500,000 home for $475,000 instead. And then your down payment would be $23,750 with your 5.5% interest. Then your actual monthly mortgage payment would be $2,864.57. And you'd have a mortgage starting with $469,300. There's also a small difference in your mortgage premium because it's a lower purchase price, just like on the last one. And on this one, you're seeing a bit of a bigger difference in what your actual monthly mortgage payment would be. In this scenario, you're saving $25,000 on the price up front, but your mortgage payment will be $228.40 higher by waiting on a monthly basis because of the higher interest rate. So again, you won't be saving any money on your mortgage payment by waiting if you think the market's going to drop by 5%. But again, that's not the whole story. With that 5% drop in prices and 5.5% interest payments, you'd still have a lower amount owing on your total mortgage after the end of your 5-year term, with a difference of $12,060. So if we look again over here at the 5-year term, the first scenario, you end up owing $433,140 at the end. Whereas in the second scenario, you owe $421,080. So that's $12,060 difference. But because of your increased mortgage payment on a monthly basis, you would have actually paid an additional $13,704 in mortgage payments over the course of those 5 years. So in this scenario, it seems like you've actually would have been better off buying a house now instead of waiting. In this scenario, yeah, you'd save money on a monthly basis. You would owe a little bit more at the end, but because of the money that you saved on a monthly basis by buying now instead of waiting, you actually would have ended up ahead. So it plays out a little bit different in that scenario if prices only went down 5%. We'll do one more scenario, but this time we're just gonna look at what if home values don't drop at all, so if they actually just stay flat, but interest rates still go up to 5.5%, what would that look like? I do think it's important to do that. In our market, it's not the same as Toronto and Vancouver. I do still think there's a chance that prices could stay relatively flat. Obviously, time will tell, but I wanted to run this scenario just so we could see what that would look like, because it is important when you're trying to decide if you should, buy now or wait, is what are some of the potential consequences. So on this one, first scenario, $500,000 purchase price, $25,000 down payment, 4.14% interest. You've got that same $2,636 monthly payment. Whereas if you waited and then the market didn't change at all, but interest rates went up and you still bought something at $500,000, you'd still have your $25,000 down payment, except now you're at 5.5% interest. Now your monthly mortgage payment would be $3,015. If the market stayed flat but interest rates went up, you're starting to see a more significant difference in your mortgage payment. On that one, you'd be paying an extra $379.16 per month if property values stayed the same, and you'd end up with a mortgage balance that's actually $10,102 higher after the 5-year term, and that's what I'm showing here. So not only would you be paying more on a monthly basis for the same house at the same purchase price, you would still owe more after the 5-year term because of the way amortization works. So you'd have a balance of $433,140 if you bought now, whereas if you bought later, at the end of your 5-year term, you'd have a mortgage balance of $443,242. Plus that extra $379 that you're paying every month would end up being $22,749 in extra payments over the course of those 5 years. Ouch. This scenario ends up being almost just as bad or just as bad as the first scenario, except this time it's worse for the person that decided to wait instead of the person that decided to buy now. So they're sort of like the flip side scenario. They're pretty close to being equivalent in some ways, where if the market values stay the same but interest rates go up to 5.5%, you lose just as much money as in the other scenario, the person that bought now, but then markets drop by 10% and interest rates go up to 5.5%. So pretty big contrast there. So what's the takeaway here? Well, based on the assumptions that I made in these scenarios, if you think that market values are going to stay relatively the same or maybe drop up to 5%, then it might make more sense for you to buy now at today's interest rates instead of waiting to see what happens, especially if you have a good rate hold that's even lower than that 4.14%. You'll see an even bigger incentive to buy now. Like if you've got something in the threes, like 3%, 3.5%, then the market would have to drop even more for it to be worthwhile for you to wait. But if you're just getting in now and you're able to get that 4.14%, that might be a way to look at it for you. Whereas if you think that the market is going to drop by 10% or more, now we're starting to get into that territory where maybe it would make more sense for you to wait instead. Obviously, it also depends on the assumptions that I made with the interest rate. I assumed 5.5% interest. We could have run other scenarios at 5% or 6% or 7%. And I'd encourage you to actually maybe spend some time running some of these scenarios with your numbers. I used the base price of $500,000 and a 5% down payment. But if you know that you're looking at a $400,000 house and you're going to put 20% down, you should run the scenario based on that. And maybe if you're putting 20% down on a $400,000 house, rather than changing the down payment amount based on the price, you might even still use the same down payment, or maybe put more money down for your down payment because you had more time to save up. So there's a lot of different things that we could change for running scenarios specifically for you. And again, I can help you with that. If you want to reach out to me at 780-819-5508, you can either text me or call me, or you can go to booktrevornow.com and select a time on my calendar, and then I'll reach out to you. I have no problem helping you with this. I know it's complicated trying to figure out what you should do, and I can help talk you through it. Ultimately, whether you should buy now or wait comes down to whether or not you think prices are going to drop, stay the same, or go up, and how much you think interest rates are going to go up. At least from a financial perspective, that's one of the things that's going to have the biggest impact. And I just want to remind you that it's not easy to figure out and time the market to get into the market at the best time. We've run these scenarios, but and we can run more scenarios for you, but ultimately either way, we're probably going to be wrong in our projections. This is just kind of showing us a few different perspectives on looking at it, and none of them are going to be completely right. Either way, there's a risk. And you'll also want to take into account all the other factors that I discussed earlier in the video about your life circumstances, your job and income situation, everything that I discussed there, plus probably more that apply just to you in making that decision. I would try not to get too attached just to what you think is going to happen in the market and interest rates. For some people, if you're ready to buy right now, it's what makes sense for you and your life circumstances, then it might make sense to buy right now. But if you're looking at stretching yourself really thin just to get into the market, I could understand how there'd be a little bit more hesitancy in that case. So I'd love to discuss it with you. You know how to reach me. I hope this video has been helpful and it wasn't too confusing or too convoluted. Let me know in the comments what you're thinking. And I look forward to seeing you guys on the next video. If you click over here, you can subscribe so that you'll never miss another video. And if you click over here, you can check out a playlist with more videos about the Edmonton real estate market. All right, thanks so much for watching, and I'll see you on the next video.